right, welcome back to the show. Today I have a cost segregation expert, Yona Weiss, and we're going to learn what cost segregation even is and learn a little bit about him as well. So Yona, man, welcome to the show.
Pleasure to be here, John. Thanks so much for having me.
Yeah. So obviously you're a cost segregation expert, and we'll get into that. You've got a podcast, Weiss Advice, and then it looks like you're also a real estate investor. What do you invest in?
Well, mostly at this point, I've been doing more limited partner, meaning not actively investing, but investing alongside other operators. Thus far, I've invested in multifamily, self-storage, mobile home parks, one retail property, but those are my main asset classes that I enjoy investing in.
Yeah. So is that just to what's the reasoning not to do it, I guess, on your own? And it sounds like you're more of a, behind the scenes guy.
Yeah, I did try it out. It just does not fit my best skill set. I mean, obviously I'm a teacher as my background. My full-time job doing cost segregation really just allows me to continue doing that, as we're going to see kind of on this show. But the operations and heavy lifting that really went into, I mean, I'm not great at underwriting. I can do it. I just don't enjoy it. And the operating of properties, it wasn't my thing. I did try it out and I saw that it wasn't my best skill set. And I figured let smarter people and people that enjoy doing it better handle that. And, listen, I'm not going to necessarily, make more money doing it as a passive investor, but I enjoy what I do and, at least put my money to work in those asset classes that I do believe in. And I do believe in investing in real estate and specifically those asset classes. So, I get the best of both worlds.
Yeah, no, well, and I think there's strength behind that because a lot of people, talk about how they want to get in the real estate and everyone feels like they have to do it themselves, which obviously that's not the case. There's a lot of ways to get into it and not have to do, like you said, the underwriting, the operations. You don't have to do that. I mean, you could just find deals for people, right? There's people that do that. So there's a bunch of ways to get into real estate. You don't have to own and operate just to get into them. So let's talk. Really quick, what's your podcast? What's that about? What do you guys talk about?
Weiss Advice. So you've been a guest on the show a while back. We really just interview successful people in the real estate world and give the platform an opportunity to hear different perspectives on how people operate their business, success stories, and really just kind of laid back conversational to learn about different people in the industry.
That's awesome. Yeah, and obviously we can, I'm sure you can find it just by Googling Weiss Advice, but we'll let you plug at the end of the show too. So let's talk cost segregation. What is cost segregation?
So it's a weird name, right? But essentially it's an income tax deduction or an income tax strategy that allows property owners to heavily reduce their income tax liability by front-loading deductions. And I'll break it down. Simply, it's like an advanced form of depreciation. So everyone understands what depreciation is. Well, actually, maybe not everyone. So let's explain it. Depreciation is a tax deduction that you get just because you bought a property. Besides for your primary residence, whether it's commercial or residential, the IRS allows you to write off as an income tax write-off the entire value of that property just by buying it. But you have to do it over a very long period of time, like a little bit every single year. For commercial properties, it's a 39-year period. For residential and multifamily, it's a 27.5-year period. But essentially, those are very long time to take that entire write-off. What cost segregation does is it breaks down the property from an engineering perspective, showing how there are different components within the property that actually depreciate faster on a 5 or 7 or 15-year schedule. And even with bonus depreciation, we'll get into that, to front load that into the first year. So you get a huge upfront deduction. And essentially what we're doing is we're taking that pool of potential deductions that we may never even see or may never even use and front loading a significant portion of them to the early years. And so what we're doing is we're creating a cash flow mechanism. We're bringing bigger deductions, reducing our tax liability during that first year, during those few, first years where it's really essential. You want to be adding more value to the property. You want to be also using your own money to reinvest to either that property or to buy other properties. And so this is a method that allows you to do so.
Okay. And I kind of want to do our best to kind of work through kind of what a cost seg deal would look like, but I'll start at the beginning. You hear a lot about everyone wants to cost seg, save so much money, blah, blah, blah. It's the best thing in the world. When is the time or times when you probably shouldn't use cost seg?
So there are a few times when, it shouldn't be used or highly recommended not to. Now, like I said, it is a tax strategy. And like every tax strategy, you have to discuss this with your CPA. You have to see if it works best for you. So John, you're absolutely right. It's not necessarily for everyone or every property type. So I'll break it down into two different categories here into when not to do it. First in who should not be doing it, and second in the type of property that shouldn't necessarily be used. And I'll start with the second one just because it's easier. Simply put, the tax deductions are proportionate to the purchase price, right? Because your depreciation basis or the amount you can totally depreciate is subjective to you as the property owner. So it starts over every time a property changes hands, which means based on your purchase price, that's how much you're going to be able to deduct. Now, that being said, the higher the property value, the more tax deductions you're going to get. It's just proportionate. So the first step is what type of property? Anything over, I would say my rule of thumb is generally $200,000 purchase price and above usually makes sense to do a cost seg on. But when you're dealing with smaller properties, maybe with single families that are, a much smaller size or obviously lower purchase price, lower value, I wouldn't recommend. So that's the first step, the type of property. And again, can be done, doesn't matter if it's single family, multifamily, storage, office, industrial, you name it, any type of property can be done. Now let's talk about who shouldn't be doing it. Okay. And there are a few cases here. Number one, if you're planning on holding the property for a short period of time, and that's relative, but I would say a year or two or less, or if it's a flip, it generally doesn't make a lot of sense to do cost seg because the main benefit of doing the cost seg is the time value of money, meaning we're not creating new deductions out of thin air. And we are basically pulling those deductions to the earlier years. But if you plan on selling a property in a short period of time, you're going to be hit with what's called depreciation recapture tax. Now, it doesn't mean, like some people think, recapture does not mean that you're paying back the depreciation. That's an important note. A lot of people think that's what depreciation recapture means. It just means you're going to be taxed as a gain, essentially, on the amount of depreciation taken. So the more depreciation deductions you've taken, the bigger tax bill you're going to have on the end when you sell. And so again, if that sell period, hold period is a short period of time, a short window, the time value of money is going to be much less. Okay. And we can get into recapture tax a little bit later, kind of go more into details in that, what that's about. But let's go back to talking about who it shouldn't be for. So that's the first thing. First thing was property size. Lower than 200,000 usually doesn't make sense. Second thing is, who's holding it, the time period. That's important. The next part is understanding, do you actually have a tax liability? Can you use the deductions? And this can be split up into a couple of different categories as well. Can you use the deductions? Meaning, do you have a large tax bill, right? And you want to save money on taxes? Most people do. But believe it or not, there are a lot of people who they're buying properties and maybe the property itself is not making money in the first year. You're putting a lot of money into it and it's already, at a loss. You already have enough deductions or write-offs that, creating more deductions that you can't even use isn't really beneficial because it's just, it's kind of like churning water. You're not doing anything. But there are actually people who can use the cost seg more than others. And what that means is income is treated differently from a tax perspective. So if you have a W-2 or you a 1099 or whatever, you have what's called active income, that is treated on your Schedule C on your income tax and is treated as your highest tax rate whatsoever. However, income from properties or from rental properties is considered passive income. Now, you may not consider it passive. I certainly don't consider it passive, even though I'm a passive investor. It's still involved, right? But the IRS treats it as passive income. That means, and this is a really important distinction, depreciation and the deductions we get from cost segregation can only be used to offset that passive income, cannot be used to offset your active income. So let's say you're making a lot of money, right? You have a W-2 or whatever, and you also have investment properties. the depreciation is great and can be used to offset any income produced from your from your rental properties. However, does not spill over to help you reduce your tax liability from your W-2. Okay, that's the really important distinction here. However, there are a few exceptions to that rule. And this is really where the power of cost segregation comes in, because where you may hear people on the internet talking about, oh, do a cost seg. And like you said, John, right? Everyone thinks the best thing to do, right? But it's really not necessarily going to be the best for everyone. And this is the main reason why. Because if you are what's called a real estate professional, and either you or your spouse is full-time in the real estate world, real estate job, and that's your, you don't have another full-time job, then the IRS actually allows you to use depreciation, these passive deductions, to offset your active income, which means, if you make $1 million and you're a doctor or a lawyer, high-paying person, you can't use depreciation to offset any of that $1 million income. However, if you're making $1 million and you're a real estate broker or you're owning properties, you can use cost seg to offset that income. And so that's the main distinction. If you or your spouse are a real estate professional, you can use cost seg and the depreciation deductions to offset your active income. And that's really the biggest distinction. There are a couple of other exceptions to this rule of what's called the passive loss or the passive activity rules. But that's the main one, what's called the real estate professional status.
Yeah, that makes sense. And it's, I think I probably maybe forgotten about it because I've been real estate professional for 5-6 years now.
Right.
But yeah, because you've heard before people on the internet, podcasts, whatever, talk about, hey, I'm selling depreciation or giving it away in certain deals. Usually syndicators are doing that. And you still have to be a real estate professional to do that. You can't be, like you said, a doctor or a lawyer and say, yeah, you know what, I'll take some depreciation. Let me in your deal so that I can, depreciate, basically, lower their income tax bill.
Right.
So
yeah, I mean, it is going to reduce your income or any gains from the sale of real estate. So it still can be beneficial in many cases, even if you're not a real estate professional. And don't get me wrong, the fact that real estate itself and the income produced from your rental properties or any investments you have can be reduced or offset or, entirely by the depreciation. Sometimes it does make sense just to do, the cost seg to help at least that income. And then you do have those extra losses, which will carry forward, can be used in the future. So it's not all bad, but it's just, you're not going to be able to maximize the benefit against all sources of income unless you or your spouse are that real estate professional status.
Makes sense. All right, let's keep going down the journey of deciding if we want to do a cost seg on one or multiple properties. My next question is, obviously you're accelerating the depreciation. Let's say you maybe hold the property for 20, 30 years. Does that depreciation run out because you're doing a cost seg? And when does it run out?
So depreciation runs out when that 27.5 year schedule for multifamily or for rental properties expires. And so depreciation never resets, which means whether you do a cost seg or not, you have a finite amount of depreciation, again, deducting the entire value of the property from the time of purchase, minus the land value. Land does not depreciate, but essentially, almost the entire value of the property we're going to be deducting. And so it's just a question of, how much are we going to be deducting when, right? Mm-hmm. And so the main value of the cost seg, like I said, is front loading, sometimes 20 or 30% of those total deductions into the first year or the first few years. But yeah, you're going to have an equal amount after that every single year subsequently. So if you take, let's say 20% of the property value in the first year as a deduction, the remaining 80% will still be spread out over that 27.5 year period. And you'll still have, an equal deduction every year, albeit, slightly less.
Okay. So, and that's something I didn't know. So cost seg is for basically that year. It's not for year two.
Well, you can do the cost seg at any point. I don't know if that answers your question, but what we're doing is we're front loading that, and then those deductions you take, that year, and then whatever remains will be taken in the future.
That makes sense. Okay. And really, this is probably meant for, like you said at the beginning, someone that's growing, somewhere where you can put that cash, right? You don't want to just take it out for no reason. You want to probably continue, you're in growth mode and you want to use that cash somewhere.
I mean, that's the point, right? I mean, if you can use the deductions and you can pay less income tax, that means you have more money to to spend, but really to reinvest, and that's going to help grow your wealth at a faster rate, because investing and growing your wealth without having to pay taxes or paying little taxes is really the fastest way. Because income tax, let's be honest, is probably the biggest expense that any individual or business has, and so if you can wipe that out or reduce that, it's very powerful to help continue that growth. Absolutely.
Yep. All right, let's talk recapture. What is it and how could that possibly look?
So recapture tax, like I mentioned, is considered an unrealized gain. So just like a capital gain tax, when you sell a property and you made more money, you sell it for more than you bought it, you're going to be taxed on that difference between how much you made. So too, depreciation recapture is the same thing. Essentially, the amount of depreciation taken during the life of ownership is going to be taxed. And so there's a combined rate of how that's taxed, a certain amount of your ordinary income tax rate on a certain portion, and a blended rate of your maximum 25% rate as well. And so that rate of what that depreciation recapture tax is always going to be less than what your ordinary income tax rate was had you not done the cost seg and had you just paid taxes based on that. So there's always going to be an arbitrage or a spread between what the rate of ordinary income tax rate, this year versus in a year or 2 or 5 or 10 years down the road when I'm hit with that recapture tax. First of all, you have the time value of money. You have the ability to reinvest that, as well as later down the road, that tax rate is even going to be less. So that's the first thing. And what that looks like is, let's say you took $100,000 of depreciation deductions, okay? And you've benefited from that to reduce your tax liability, and you come to sell the property. You're going to be taxed on that $100,000. Again, different rates. Let's say it's 25%, so a $25,000 tax. Now, that does not mean that you have to pay that tax, because being subject to a tax is not the same thing as having to pay a tax, right? Similarly, just like CASE, right? You make money, you're going to have an income tax liability. Well, guess what? We can do a CASE. We can reduce that income tax liability. So too with recapture tax. There are strategies to either defer, offset, or completely eliminate that recapture tax as well. So the first and most foremost one is doing a 1031 exchange. Just like it defers the capital gain tax, it also defers that recapture tax. And so that's one way just to kind of kick the can down the road a little bit more. There's also something called opportunity zones, which is a strategy to buy properties in specific locations around the country. Every state has different zip codes that have been designated as these opportunity zones. And what that allows you to do is to invest in revitalizing. It has a lot to do with construction and renovating properties to revitalize these communities. And the government gives incentives and says, if you invest money into these areas, and there's certain criteria in doing that, and we're not going to give a whole masterclass on opportunity zones today, but essentially you can defer any capital gain tax or recapture tax that's coming from any source. So if you made money in the stock market or Bitcoin or whatever it is, and that would normally be taxed at a very high rate, you can put that money into an opportunity zone fund, investing in a certain area, and defer that capital gain tax. And if held for 10 years, I think is the rule, and certain other criteria, then you can actually completely eliminate that capital gain and that recapture tax. So that's another strategy a lot of people use. There's another thing called partial asset disposition. And this may be something that's a little confusing. Most people don't know what this is, but essentially what it is when you sell a property, if you've held it for a certain period of time, then there are certain components of that property that no longer have value. Because with depreciation, what we're doing is, let's say, we have a property and we're saying that 20% of the value of the property is going to be in our 5-year property. Now, 5-year property is considered personal items, tangible property, things that are movable or things that are non-structural. So think about like appliances or furniture or equipment, cabinets, countertops, shelving, all the kind of stuff that's not essential to the structure, fixtures, window treatments, all that stuff is considered 5-year depreciation. Well, if I've done a cost seg and you buy $1 million property, let's say, and I've established that 20% of the value of the property is in these 5-year components, right? Let's say the carpeting, right? I'm going to say the carpeting is worth $10,000. Now, when I sell the property and I've done a cost seg prior to that, now I can show that that $10,000 carpet no longer has any value because it's been 5 years, or even if it's been less than 5 years, you can show that it has no value left. Well, when I come to sell it, I do this thing called partial asset disposition, and I basically can write off the value of those 5-year components, say it no longer has any depreciation value, therefore I'm not going to have to pay recapture tax on that value because there's no more value left in it. And so this is a great strategy. It's not automatic, which means it's a special form you have to fill out, and you have to have done a cost seg beforehand. So it turns out that by doing the cost seg, it actually reduces, by doing this partial asset disposition, it actually reduces or eliminates the recapture tax on a lot of those 5-year items. So that's something really important. Like I said, most people don't know that exists. And then finally, another thing people don't know is that you can use depreciation from one property to offset the gains from the sale of another property. So, you bought a property, held it for a few years, sell it off, and you're hit with this capital gain, this recapture tax. You don't do a 1031 exchange. Well, guess what? You can do a cost seg on another property in the same year and use the losses or the deductions from property B to offset the gains from the sale of property A. So all in all, it is something that needs to be, you need to be aware of it. And it certainly can come as a big surprise if you're not planning for it. But you also have to know there are many strategies out there, like I mentioned, that can be used to either defer, offset, or completely eliminate the recapture tax.
That's interesting. This is such good stuff. I've never heard of the partial asset disposition. So I think a lot of our listeners, or at least majority of them, are probably self-storage owners. The self-storage, is there obviously there's no carpet. So is there anything there that you can use?
Yeah, absolutely. Self-storage can be a great asset to do cost seg on. And, there are different components inside or outside a property that will be depreciating at a faster rate. I think the biggest things for storage is if there's climate control. That's always a big item. Even the doors, security systems, lighting, and outside the property is considered land improvements is on a 15-year schedule. So that's also beneficial with a cost seg and can include, the pavement, concrete, if you have signage, fencing, outdoor lighting, anything like landscaping, anything like that, all that has value. And again, is on a 15-year accelerated depreciation schedule and is beneficial for the cost seg, also is eligible for the bonus depreciation. So all in all, most self-storage properties are typically, comparable to multifamily or other types of properties when it comes to the benefit with cost seg.
Do any of those items that you just mentioned fall under the partial asset?
Yeah, everything. Anything that is on a faster depreciation schedule than your structure. Again, the structure of every property is going to be in that longer 39-year schedule, but everything we are identifying with the cost seg and those components that depreciate faster, those are all going to be eligible for bonus depreciation, and they're all going to be eligible for the partial asset disposition to write off. Awesome.
Okay, I've never heard that. That's awesome.
Yeah, it's we learn every day.
Yeah, absolutely. Well, and this is something that that I've learned, but it took a little while to figure out. CPAs are great, but a lot of them are just trying to file your taxes, right? And even if you ask for their advice, maybe they'll give you some things here and there. They're not giving you any of this stuff. Most of them aren't that I've ran into. And that's not saying they're not doing a good job. It's just not what they're doing, not their job, right? So obviously reaching out to someone like you, that you can dive a lot deeper into, things that can benefit your property and portfolio. So let's kind of transition into, if we can.
Yeah.
You gave some generic examples of $1 million property. Let's pretend it's self-storage.
Sure.
Can we kind of walk through what that might look like?
Yeah, absolutely. Okay. So first thing we always like to do in the process is we always run a free upfront analysis and estimate. So you can know ahead of time what the potential tax savings for a specific property is. So if you have a property that, you're looking to buy, or you're under contract with, or you already own, or you've owned for a number of years, you can do the costing. We can do a free estimate, and you can see ahead of time. So that's always very helpful, very educational to kind of see, well, what am I getting into? How much is it going to cost me? And, what's my actual tax benefit going to be by doing it. But let's just give this example: $1 million property. We're always going to have to subtract a certain amount for land, and that will depend. It is completely subjective to the property location, right? Generally speaking, every county has a different method of establishing land value, and so you generally have to go off of the county assessor's value of land to improvements or land to building. But the national average is about 15% for all types of properties. Now, again, there are certain locations, like in California, for example, very high land values. If you're on a beachfront location, very high land values. You're probably not going to have too many self-storage properties out there. I know you're in the Midwest, right, John? So it's not you're not going to be dealing with beachfront locations over there. But it is important to know that will make a big difference. Meaning, if you have $1 million property, you have a 15% land value, so you're left with $850,000 we can depreciate, which is great. If you're in California and you have a 60% land value, then you're left with only $400,000 we can depreciate. So you can see a huge difference, because from that tax basis, or that 850 or 400, that's what we can work with to now break down that value into these different depreciation components, these different values. So typically speaking, let's take an example. $1 million property, let's say take off 15% for land, we're left with $850,000. Without cost seg, your normal depreciation deduction, again, we're going to divide that by 39 years for self-storage commercial properties. You're going to have about $21,000 deduction every year. Okay, just simple math, right? 850 divided by 39 is 21,000. Now that's great in and of itself, right? Again, you buy a property, you're making money from it, right? How much are you going to make? If it's a 5 cap, you're making $50,000, right? Net operating income. Then immediately deduct 21,000. You're only going to be taxed on the remaining, 29,000. So, it is beneficial, regular depreciation in of itself. What cost seg can do is we can come in and show how certain components are going to be going on these faster 5 or 15-year schedules. 5-year property can include anything that is inside, non-essential to the structure. So again, remember, the structure is always going to be the main value, right? Doors, windows, foundation, roof, all that stuff, infrastructure. But in a storage, you're going to have, like I said, climate control. You're going to have shelving. You're going to have the doors. You may have, any type, some type of flooring you may have. You maybe not. Maybe have security systems. You have lighting. All of these different things are going to be on this 5-year category, as well as if you have an office within that property, a lot of the office furniture and things like that are going to be in there. Now we go to the second category, which is the 15-year. I mentioned that also has 15-year property. Obviously, there are different types of storage facilities, but if you have land improvements, meaning you have a parking lot, or you have concrete, you have asphalt, right? You have landscaping, fencing, retaining walls, whatever it is, anything that's outside, that's not the land itself, but what's on top of the land, all of that has value and is depreciating on its 15-year schedule. So adding up between the 5 and the 15, typically for self-storage, we're going to be somewhere between 20 to 30%. Sometimes it can be as high as 35 or 40% of, again, that value. So let's take our example, $850,000 tax basis, and we take, let's just be very conservative, 20% of that. Okay, 20% of that's going to be about $170,000. That's going to be in these faster depreciation categories. With 100% bonus depreciation, which allows you to take that full amount in the first year, which this year it's actually very likely to come back as a law. It was that way between 2018 and 2022. But without too much details, that means you can take $170,000 tax deduction right off the bat. Okay, so that just shows you the power that a $21,000 deduction versus a $170,000 deduction is pretty clear, showing that. Now, even without the bonus depreciation, we're still going to be doubling or tripling that deduction, because if we're taking that $170,000 over the first 5 years, so instead of the $21,000 deduction, we're going to have about a $50,000 deduction during this every year for this first 5 years.
Gotcha. That makes sense. Yeah, that was really well laid out. Okay, so if you're doing 2024, 2023, no bonus depreciation, that's over 5 years. Bonus depreciation, more than likely, will come into play. You can write all that off year one, and then you're back to just regular depreciation, right?
Then you go back to everything's going to be the remaining structural value, which again can be 70 to 80% of the whole value of the building, is still going to be on that longer 39-year schedule. Yeah, and I should mention that there is still bonus depreciation at this point. It's just not 100%. So it phased out. So if you bought a property in 2023, it went down to 80% bonus. If you bought a property in 2024, it went down to 60%. This year, currently 2025, it's down to 40% bonus. But again, it's very likely to come back in a tax bill that's been passed in the House and waiting to be voted on in the Senate. So we'll see if it comes back to 100%. And so what that means is if you bought a property, in 2024, haven't done your 2024 taxes yet, let's say, and you're on extension, 60% bonus means you can take 60% of those accelerated deductions in the first year, and the remaining 40% will still be on that faster 5 and 15-year schedule, but you don't get, the whole 100% bonus up front. So it's still beneficial, but not as powerful as the 100% bonus.
Okay. So let's say you're somebody like me that has not done cost seg whatsoever. And I've got double digit facilities. Should I maybe wait till it's back in play?
Well, for someone like you, John, I assume there are certain properties that you've owned that you bought between 2018 and 2022, right?
Yeah. Yep.
And if you never did cost seg or bonus depreciation on those, they are still eligible for 100% bonus depreciation. So because again, it goes based on when the property was purchased or placed in service and not when you're doing the tax filing on that property. Yeah. So it still can be extremely beneficial. And if you haven't filed 2024 yet, it's definitely something to look into. But again, going back to our previous discussion, has more to do with yourself. Do you have that tax liability? Do you have income tax that you want to reduce or offset? And obviously, by you being a real estate professional, you're going to benefit personally from this more than anyone else, because any source of income that you or your spouse have, can be offset or by the cost seg. So definitely makes sense to look into. But obviously, that's a decision you can make when you look at the numbers.
Yeah. This is awesome. I don't know. I mean, you've answered everything more than what I was hoping. So what I missed? Anything else?
What did you miss? You did mention something earlier about CPAs, and not all of them are really cut out to give you tax advice per se. And I would make a big distinction there. There's most CPAs, and you're absolutely right, it's disappointing that all they're doing is just punching numbers and filing taxes. You give them the information and they just fill out the forms. That's not what you want. If you're investing in real estate, you want a tax advisor. You don't just want a CPA. And there's a big distinction there. Now, there are plenty of CPAs out there who are also tax advisors who are going to be proactive and give you advice and show you different ways to reduce or offset. But don't expect, just because you have a CPA that you've been with for 10 years or someone in the family or whatever, that they're going to be proactive at doing that. And so take the time. There are plenty of real estate CPAs out there who do focus on tax strategy as well. You can Google it. There's I can give a couple plugs here. There's the real estate CPA. You can just Google like the real estate CPA. It's a great company. They have a ton of CPAs on their team, and they have a ton of amazing content. And you can Google that, right? There's the investment friendly CPA, another guy, Ashish, that I know. You have My Online Accountant, who's also a good friend of mine, real estate focused CPA as well. Amanda Hahn, who's famous from Bigger Pockets. She wrote a couple of books for Bigger Pockets, right? The tax savvy real estate investing or something like that. Amazing. Again, these are people who are focused on real estate, who are focused on tax advisory, not just filing the taxes. They will be a little more expensive probably than just your normal number puncher CPA, but obviously worth their weight in gold because of the savings and the strategies they'll give you. So, be proactive when it comes to taxes.
No, that's great. And I asked you to plug those because, to be honest, I've done a bunch of searching and could not find a maybe qualified tax strategist. Obviously you can Google them and something will pop up, but and this is something myself, and actually we've got a mastermind we've talked about. So yeah, that's great. Cause I've been bouncing around the CPAs, and it takes a little while to figure out like, oh, they're not really tax strategists, and that's a whole different concept, whole different company, everything. So
yeah.
But like you said, can definitely be beneficial. So
for sure. And all the aforementioned people are people that I've known for years and have worked with them and their clients. Our company, we just focus on the cost seg. So we're not an accounting firm. We're not doing any of that tax filing or tax strategy, but can definitely help and make that connection for sure.
Yeah. And what's interesting, I'm not trying to take any work away from these people, but about 2 weeks ago, I decided, you know what, I've been using ChatGPT a lot lately, and I actually uploaded my returns from a couple of years ago, and was like, maximize, my savings here, and it went through everything that's done right, everything that I could maybe add to it or tweak. So if you think there's something that your CPA is missing, feel free to try Chat GPT.
That's fascinating.
It's safe with personal information.
I would hope so.
Yeah.
But did Chat GPT recommend cost seg for any of your properties?
I did. And then I asked which ones. And
That's
it gave
cool.
me a breakdown of which ones. And I had to obviously put some more information in there, but
right.
Yeah. And that's kind of where me reaching out to you for this podcast.
That's hilarious.
Yeah. Cause now I'm definitely on board for cost seg, because I've I didn't understand a lot of it. Right. And a lot of it was the recapture. So I'm glad you explained that, because I think a lot of us, we don't understand the ins and outs, and I didn't understand the recapture and how that worked. I didn't realize it was just your tax on the recapture, not the full amount. So
right.
It's good information. Cool. Well, you've answered a lot more than what I was hoping for. This has been absolutely awesome. Obviously, you've got a podcast. Go ahead and plug that. And where else can people find you?
Absolutely. Weiss Advice. Check it out wherever you listen to podcasts. And I am very active on a lot of social media platforms. LinkedIn is by far my most active, but very active on X, Instagram, Facebook as well. Please send me a little note, connect with me over there, follow me, whatever you want to do, but send a little note, take 10 seconds and say, you heard me on the show and I just want to connect. It literally takes 10 seconds and makes all the difference, and happy to help. If anyone has a property they want to look at and run a free estimate, we can do that. So reach out. You can also go to yonaweiss.com and learn more.
Awesome. Yeah. And you're very responsive. I'll say a lot of people that'll plug, they're a little slow. You're very responsive and on top of things. So definitely appreciate that. Appreciate you coming on. Awesome information. And we'll see you guys next time.
Thanks for following, subscribing, and listening to this episode of the Do More podcast hosted by John Farling. To learn more or ask questions, go to l4investing.com.